Brandt from the OECD, Stephen Kinsella from the University of Limerick, Südekum from the University of Düsseldorf, and Sebastian again, who's worked on a quantitative forecast very recently and gone through this question of how deep will this crisis be. I think that's essential to better understand, because then there's the next question that will have afterwards, or in the afternoon, essentially, what need governs, what doesn't do governments need to do, and central banks, is it enough what they have already done or not? So I would like to hand over to Sebastian first and let you present your forecast, very recent forecast, on what this crisis may produce in Germany. We'll then pass on to Nicola, who will talk about the OECD, and then we go to other countries in the discussion. Please, Sebastian.
Okay, let me share now the screen. Okay, you should. Okay, so thanks again. What I'm going to present to you now is our forecast from, well, published about 10 days ago, and forecasts at the moment are moving targets, and I would like to talk a little bit about what an economic forecast can do for us at the moment anyway, and then show the forecast, slightly contrast what we are seeing to what the IMF and the other German institutes are seeing, and then have a few words on economic policy conclusions. I think that the problem, or the basic problem, we all the forecasters have, that we have no historical precedent what's happening now, and it's also a bit difficult to frame what we are seeing in the standard terms of supply and demand shock, because in a way it's a combined supply and demand shock. But when the stores are closed, is this now demand shock, or when they are not allowed to open, is this a supply or demand shock? Because if this were a normal supply shock and demand would remain the same, you would expect price increases, which we don't see. So you see, it's not the standard types of shock we have seen in the past. And therefore, we have an extremely large degree of uncertainty. This is amplified by the fact that we don't have good numbers. We don't have good numbers about infections. We don't have good numbers about how the economy is doing in real time. The first real good indicator we are going to see are the PMIs to be published this week. So in a way, the only thing we can give you now is to provide one plausible scenario, but the scenario which has some value added, because it includes feedback effects. So we can have the effects in here that lost production and lost income has over the coming quarters on future consumption and hopefully investment. And we can show the reinforcing effects through international linkages. And for our forecast, I always say that when I'm presenting it, our forecast is an optimistic forecast. So we have, for the assumptions, we have rather erred on the optimistic side. Of course, we could have come up with another horror scenario. You can always think at the moment of things which could go wrong, and then we end up in a deep decade-long depression, leading to who knows what. We haven't done that. We still think it's a plausible forecast, and it is our main forecast, but it is optimistic. For example, we assume that policymakers are doing broadly the right things, which in Germany, in our views, economic policy-wise, they have done. Of course, there's always downward potential here, but we don't necessarily have to count on it. We assume also that contact restrictions are gradually relaxed from May onwards, meaning that large events will remain closed throughout the year. And we assume, and that is also crucial, that the short-term work scheme by the German government will be widely taken up. So in our forecast, we come to a peak of short-term workers of more than 4 million in the second quarter. Just to give you some comparison, in the crisis of 2008-2009, which was unprecedented for Germany, we had 1.5 short-term workers. So we now go roughly 3 times that much, and I think the other institutes are only around 2 or so. That being said, I think there's even an upside risk that we will see even more short-term workers going to 6 or even more millions here. This is a positive thing because it shows these people have not lost their jobs, and that means if demand gets up again, we might see rather decent recovery, but I'll come to that in a moment. This is our forecast. We are at minus 4% here. If you do that because of the special way the Germans do their calendar adjustment, if you do this in the international comparable variables, we come to minus 4.4. This means we are a bit more optimistic than the International Monetary Fund, but what is important and is different from most of the other forecasts we are having in Germany at the moment is that the recovery is, well, it looks like a V here, but if you look at the red line, you see that at the end of 2021, GDP is still significantly below what we had in 2019. So we are not, in this way, there's no quick recovery we are seeing here, even in something which we would say is a very optimistic scenario. This is the most optimistic part, and I think maybe we have to rethink this in our at some point in the future. This is our labor market. We see only if we go for this optimistic scenario, the drop in employment itself is not that dramatic. It is dramatic in the number of hours worked, but a lot of that in our scenario, in our forecast, will be cushioned by the short-term work schemes. And we had yesterday, we have published the Huntzberger Foundation survey among workers in Germany. And this is basically, there are 15% of the workers who have been surveyed are saying that they are working shorter times now. So that basically is in line with our forecast. There will be a drop in investment, and this also will not recover completely. We are, if you look at, this is fixed capital formation for equipment. You see again at the end of 2021 we are still below the level before, and that even at the point where this investment wasn't very strong to start with. Exports have a drop of almost minus 7%, so there's a huge drop and a huge amplification through global supply chains. I'll say a few words on that in the end. And consumption is holding up, well, better than other components, but still you see here the drop in consumption, especially during this year, which is because first off the contact restrictions, but then because people will have lost their income, because the short-term work schemes in Germany, they only pay 67% of your lost income. So, and if you don't have dependents and children, only 60%. So that means that the retail workers we are seeing now who have been set on 0 hours in these schemes, they lose 40% of their net income. And of course, that has repercussions for aggregate demand and consumption going forward. Where are the differences from our view to other institutions? There is a group of German institutes which twice annually presents a forecast for the German government that's called the Gemeinschaftsdiagnose, and also the Sachverständigenrat. They see a much quicker V-shaped recovery, and we don't. So in their eyes, they don't actually call for proper stimulus package, but they say basically, as it is, what is lost this year will just be recovered next year, and everything is fine. The IMF, in contrast, sees a deeper drop, then a bit faster recovery, and ends 2021 roughly where we are. Well, we will see whether they are right. In my eyes, what is a bit strange in their forecast is that basically there's not much difference between the drop in Germany and Italy. I can see that, well, we all are hit by the same global forces, but still I'm not sure whether that is completely plausible. What we fear, what others don't, is that we fear that there's a persistent weakness in aggregate demand. We have income lost, we have increased debt levels, and I'm not just talking about government debt, public debt. I'm not that concerned about that, but we have increased debt levels for all the companies which now have lost sales. That means they might move towards repairing their balance sheets and cut back on investment, and we will see damaged bank balance sheets. I mean, first, the banks have to bear some of the losses, and second, when you look at the rescue packages, a lot of that is bank loans. Even though the bank loans are partly guaranteed by the federal government, that still means the banks have to put equity capital behind these loans, and that might mean that in the recovery they have less equity capital available to give loans to other sectors. Just let me end with some economic policy conclusions. As we see it, there are three elements necessary to stabilize the economies in this crisis. The first phase is you need to provide liquidity quickly and stabilize incomes. And then in the second step, you need to stabilize the sales expectations about the future. Companies have to believe that going on from Q3 onwards, they will see a rebound to the old levels of sales. Otherwise, they will just fire people and you have the negative feedback effects. And well, if they have halfway rational expectations, you will only be able to do so if you bring aggregate demand back to pre-crisis levels. And here is where a stimulus package seems to be necessary. And just something I said also in the first session, and I would like to illustrate that. Most of what we are seeing now is not the immediate impact of closing down retail stores and restaurants, but is the feedback we are going to see through the world economy. I've now taken the IMF forecast here, just to say that that is not biased by what we are forecasting. And if you look at these countries, they have all a very similar drop. Italy a bit more, but still, I mean, Germany and Sweden is pretty much the same. And if you follow the debate, that should be a bit surprising, because Sweden is seen as a country which has very little lockdown measures, where schools remain open, where retail stores remain open, but still you have a similar drop in GDP. And that shows that this is now coming mostly through this globally synchronized slump. And what that means is that ideally we would need an internationally coordinated stimulus package. We had something similar to that in 2008, 2009. That was not ideal, but G8, G20, they actually coordinated something there. At the moment, we don't have that. And still in Europe, we have the problem that the way fiscal policy is done here, Germany has much more fiscal leeway. It is blocking Corona bonds, means that something which was an asymmetric shock at the beginning, Italy being hit more than others, is now turning in an even more asymmetric shock, because Germany might be stabilizing more, and this really is a real risk which we must not forget in the debate. That's from my side. Thank you very much.
Thank you, Sebastian. So I would like to hand over to Nicola, who's from the OECD, and the OECD forecast is a little bit older, but I think you're in contact with your Paris colleagues, and maybe some update you can give us on the state of OECD forecasting on the Corona crisis. Please, Nicola. We can't hear you.
Hey, no.
Yes.
Sorry, can you see me now? Can you hear me?
Yes, both.
Okay, sorry. And I was, and do you see my screen?
Yes.
Okay. Okay, let's go. Yes, indeed. So our March interim economic outlook is certainly outdated. So that's not what I'm going to show to you. I'm going to show you some elements of thoughts, basically, of how we look at the economy at this stage. We're going to come out with a fuller projection in May. So I have perhaps two key messages for you in this presentation. One is that the high frequency data that we have looked at certainly confirm that the economic impact, the fallout of this pandemic is worse than what we've seen 10 years ago at the global financial crisis. And then if we think about exit strategies, we've talked about already a little bit. What we think it will is that it will be all the more effective the more we will cooperate. across countries on this to understand the epidemic, to control it, to ramp up our healthcare capacity and testing capacity, but then also to support the recovery once we can exit the lockdown. So here I'm showing you a compositive PMI, so measure of activity. And basically my main message here is if you compare 2008 and 2009 and the place where we are now, it already looks worse, certainly. We've also looked a little bit at more unusual measures. So Google Trends, where people look for things like construction, retail sales, and trade. And what you can see is that in the countries with stricter lockdowns, contradicting a little bit what Sebastian said before, at least according to these indicators, the slump does look a little bit steeper. And also just another element to, to help us think about just how unusual this economic crisis is, of course, is the disinterest or the breakdown, if you will, of the international flight network. So that's something which is certainly, it affects tourism, but also international supply chains and services. Certainly something very unusual compared to what we have seen before. So as I said, we don't have new projections. What we did do is look a little bit at the initial impact of complete or partial shutdowns, and basically just looking at what we think in terms of sectors, what is going to be shut down. So this is just the initial impact, what I'm showing you here, the no feedback loops from trade, etc. And what you can see is that the immediate effect on activity is really steep, to the order of almost 30% in Germany. Partly this is because, we have a large car manufacturing sector here in Germany, and we are assuming full lockdown here. Also because the supply chains, of course, are interrupted. And this is a slide that basically, talks you through or underlines how different this economic crisis is from what we've seen before, the recession that we're looking at. So usually we have, not going to talk you to all of it, just some points perhaps. So certainly the cause of the recession, of course, is exogenous. It's a pandemic. It's global. So by now, almost every country in the world is being affected. Of course, then the breakdown in demand that we're seeing during the lockdown is very unusual as well. Usually we have consumption and investment falling gradually, investment more sharply. Here we have entire categories of consumption that are simply not there. Supply chains are breaking down, and there are complete investment halts in some sectors. And then perhaps to talk about fiscal policy, how it's different from what we usually look at in severe recession. So usually we're looking at, well, either we let automatic stabilizers play, or we have some aggregate demand management. Here, of course, it's different, because what we need at the moment during the lockdown is life support for firms and workers. And beyond that, also ramping up of hospital capacity, testing capacity, in order to get this disease under control and be able to release the lockdown gradually and get back some normalcy. So it's more spending that's required, but also in some ways, but also different. And perhaps one thing I want to stress at this point is that, what we see in the support package that we're seeing in Germany is several orders bigger than what we see, for example, in Italy and Spain, countries that are harder hit, but also in a more difficult situation in terms of debt and economic activity. And so that is also one reason why the call for cooperation is very important, because, well, it won't help us if we control the disease just in one country, right? We can't keep borders locked forever. Otherwise, we will not go back to normal economic activity, and we will not be able to restore supply chains. And this is just a graph of what could happen through the exit strategies, different phases that we will go through. So phase one, we are gradually leaving this now, expanding healthcare capacity, testing capacity while we are in the containment. And we are now, at least in Germany and some other countries for sure, trying to gradually release these measures. One thing I would want to, and of course we need a fiscal policy, monetary policy to as some support. Here, even more in phase three, when we can take up some more economic activity. Of course, this is where demand support might be needed. But what I do want to stress in terms of cooperation here is also that I think there's a big chance that we have, because countries are going through the exit strategy at different pace, to really try to understand which of the containment measures are the most effective ones, and where there might be less of a risk of spreading the disease again. So, for example, Denmark opening schools now, this is really something we should observe very closely, because there's some indications that maybe children are not the big spreaders of the disease, but we don't really know. It will be very important to understand, because we want to go to phase three, right, where we really ease border controls. Perhaps even mass gatherings might still not be possible, but we normalize economic activity. And but another scenario, which would be much worse for the economic activity in individual countries, but also the global, even more so the global economy, is if we have to go back to phase one, to containment, because we get another outbreak of the disease. And this is also, of course, what's going to govern these different scenarios. Will we be able to go to phase four, where we have a vaccine and we can somehow control the disease rather soon, or will we have another wave? This is really what's going to determine how bad the economic slump is going to be that we're going to look at this year. And that's all I had to say from my side.
Thank you very much, Nicola. Very instructive and helpful. I would like to pass over to Stephen Kinsella from the UK, and may bring in some Anglo-Saxon, Anglo-American view, where, as we know, the disease is hitting people harder than in Germany. So, Stephen, I'll hand over to you, please.
I'm sorry, Stephen. This is proof that it's not just the British that think that Irish independence has not happened. I'll have a word with Thomas at another point. Yeah, you need to.
Yeah, still, please
unmute. I think the phrase of the lockdown is "you're on mute." Can everyone see my screen? Is it possible to? Have you guys been able to see my screen yet?
Yes, I can.
Okay, great. Yes, I'm Stephen Kinsella from the University of Limerick in Ireland, which is not part of the United Kingdom, hasn't been for a while. Well, most of it isn't. I think that's probably fair to say. Yeah, thank you very much to the organizers for the invitation to speak. It's I think one of the really instructive things about this is just how quickly everybody's come together to try to understand it, and how people are bringing the various strengths from their own individual disciplines and their own individual national perspectives to try to understand what's going on. Economists are learning about epidemiological models and epidemiologists are trying to figure out economic models. It's interesting that only a few years after we were told that we didn't need experts anymore, that experts are back running the show. So it's a very interesting, if very, very scary time for lots of people. So really, what I want to do in my remarks is to give yes, certainly an Anglo-Saxon approach, even though I'm I suppose a bit more Celtic, but really to have kind of a view towards the interaction of the macroeconomy and the microeconomy, and particularly in the UK and the US, and maybe across the Western world. So before I do that, I want to just give you 5 thoughts that I have on the evolution of the crisis so far. The first thought is that our controlling metaphor is wrong. So the controlling metaphor that you'll read in most op-eds, most editorials, most places, is that the economy is in a coma. You know, the notion being that once we just wake it up out of the crisis, that it will be largely fine, right? Might need some physiotherapy, might need to do some exercises, but more or less it'll be what it was when we put it artificially to sleep. I think that controlling metaphor is completely wrong. It's not a COVID-19 is not a coma. I'd be far more on the side of Sebastian. I think it's a damaging and persistent aggregate demand shock, and it's a heart attack, right? The appropriate controlling metaphor is a heart attack where there's the death of this segment of a heart muscle, and that's caused by a loss of blood supply. In this case, a loss of demand and a loss of sales for the individual firms. So the question then pretty much immediately is, how much of the damaged private sector can we save, right? So what policies operate in the short, medium, and long terms to actually save as much of the damaged private sector as possible? I'm going to argue that really we're in a situation where forecasts are not helpful in a certain sense, because any forecast based on an equilibrium model that has relatively stable parameters is almost certainly, I mean, everyone says this, but it's important to say it. I think it's wrong. Models could actually be worse than wrong for some time, in that if they guide policymakers' behavior towards the downside of the forecast, and things turn out to be much worse than policymakers feared, then in fact the model will have done the public a disservice, which is exactly what it was designed not to do. I think it's important that we recognize just how much uncertainty clouds everything. I see lots and lots of models every day through the various initiatives I'm working on, and they all have 95% confidence intervals around central line forecasts, and I just don't think those should be put there. I think it's far better to have narrative approaches to say scenario A, scenario B, scenario C, and move on. One thing I think is really important to understand is that balance sheets are the object in the economy that links the macro shock to the micro outcome from the private sector perspective. So what I mean by that, I'll give some illustrations in a minute, but effectively what I mean by that is, if you turn off a firm's sales for 3, 4, 5, 6, 7, 8, 9 months, and then you expect it to switch back on again, you know, in December or in January or whenever, it can't simply switch back on because the balance sheet has been impaired by the existence of the crisis. That's why I'm saying it's not a coma, it's a heart attack, because the balance sheet itself is being damaged by the experience of the crisis. Focusing on policies that heal balance sheets will help us save as many firms as we can and limit the explosion of unemployment that will inevitably come. I think the IMF forecast that were referred to in previous remarks, they are, if you like, the business as usual forecast. They assume a return to an equilibrium path that ultimately may not exist. I think everyone here lived through the last crisis, and I don't know if you all remember, but in 2007 and 8 and 9, we were looking at forecasts that showed the economy recovering in 2 or 3 years. You know, every single forecast for every single country, the economy recovered in 2 or 3 years, and that's simply not what happened. I'm Irish, as we said at the start, and it took us 10 years to recover a balanced budget, an entire decade of deficit spending on behalf of the Irish government. So we actually got back to a budget surplus in January of this year. So we had a surplus for approximately 90 days before it went away again in a big way. I forget which writer said it, but you know, somebody said to be Irish is to know that you will suffer, and I think that maybe applies to the poor officials in the finance ministry. Anyway, I want to just give kind of a couple of illustrative, just Excel exercises that just really help me clarify why these linkages mattered in the next few minutes. All right, so let's just take 4 possible COVID futures. Okay, so if we could go back in time and go back to January and get the people of Wuhan to wear masks and maybe just contain the crisis as much as possible there and let the rest of the economy move on, we would have this. So there's no global COVID crisis. Effectively, the economy grows at the IMF's growth rate. So these are months. So this is, you know, 3 years, obviously. And the economy just kind of, the world economy just kind of grows, right? And that's fine. And that's sort of the benchmark for me as to where we should have been absent the global COVID shock. Okay. I think what we'd all love is, I mean, not love, but we would prefer is a crisis like this, where it's a short shock over, you know, a year. There's a very steep decline. We noticed that in the PMIs data that was shown earlier. And then there's a very muscular fiscal and monetary policy response. And as the crisis ends, the economy shoots up because it has been released, if you like, from its cold storage, and up it comes again. Okay, that's, I think, what we would all love to see. It's the state as savior. The private sector stays mostly intact. The people whose jobs have been lost, they return to their workplaces, and we mourn the dead and we move on. I feel that a longer shock is much more likely, which looks a lot like this. There's a severe drop in output, and then the economy recovers at a much slower pace. So it takes 4 or 5 years to get back to where it was under this this scenario. And this is a 25% drop in output, and then it just kind of continues. However, there is a disaster scenario. And the disaster scenario is that global supply chains fragment. I think Sebastian made the point that most of the damage that's come to GDP has actually come from the fragmentation of global supply chains. And the worry, of course, is that if you think about financial flows as moving from left to right on a map of the global economy, and if you think about global value chains as moving services and goods from right to left, if you fragment those things, you end up with pools of finance, and you end up with pools of goods and services in different places, and that accelerates the trend toward a multipolar world. It creates an underlying dynamic where, if you want to call it deglobalization, just an increase in the cost of transacting across borders, and it just means that it's much harder for the world economy to recover, because everyone is hoarding in a certain sense for their national capacity. In this situation, we have a disaster where we lose an enormous amount of economic output, and there is, in this scenario, there's no historical precedent for something like this. This is, in my mind, this is the worst of all possible outcomes for the economy, and it's very much my hope that it's a shorter shock, but I think the degree to which the shocks are understood and felt by if you like, the local economy is the degree to which balance sheets are impaired. So what I've done is I've just knocked up this very simple simulation of a firm that has 500,000 euros in sales, and the sales fall 50% in month 13. So it's going along grand, and then the COVID crisis hits. It has to shut. It lays off all its workers. But because it lays off all its workers, the government is paying the worker salaries, so its labor cost is zero. Its operating costs do not return to zero. This is really important. It still has to pay its rent, it still has to pay its taxes, it still has to pay its electricity bill, even though there's no electricity going through the shop, because of course the shop is closed. But if you assume that the operating expenses drop by 50% as well, then only a 3-month shutdown leaves the firm with really large amounts of arrears. And those arrears need to be paid. If the government gives a loan, the Irish government is giving working capital loans at 4.5% at the moment. If you work that out over the rest of the term of this simulation, it takes the firm, as you can see, 18 months to recover from a negative profit or from a loss to a positive profit. And in that whole time, it's actually accruing arrears owed now to the government. Okay, so the longer the shutdown takes place, the more arrears accrue on the balance sheets of the firms. The more arrears accrue in the balance sheets of the firms, the more likely the liquidation computation will be to simply liquidate the firm. And this is I should say, a fairly heroic simulation, because it assumes a 3% per month growth in sales after this very short shutdown happens, which is, you know, it's weird to call this the rosiest scenario, but I think it is. So even in the rosiest scenario, it takes 18 months for this firm to recover, and its balance sheet is impaired. Now, we've all seen this from our undergraduate classes. This is the balance sheet of any particular firm. The assets are on the I guess it's your left. The liabilities are on the right. If you look at the non-current liabilities that are they're falling due in more than a year, you've got large outstanding loans, deferred tax liabilities, pension provisions, and debt securities. We're assuming a smallish firm with 500,000 euros of sales, so it doesn't really have the ability to issue debt securities and all that. It probably only has very limited deferred tax liabilities. The pensions might be for the owners and a few employees. It's not a big deal. The big deal for this firm are the current liabilities: loans payable and income tax payable, and any deferred income. The key issue from my perspective is to understand how the balance sheet of a firm, that, you know, there's no moral hazard here. Nothing has gone wrong. This firm has not failed in some sense to do its job, to manage its money, to find its customers. The firm has been told by the state, shut down. And so the firm has done that. It strikes me that the principle here should be to maintain as many to make balance sheets as helpful as possible, as healed as possible, and to maintain equity within the firm if it can at all be saved. And so thinking about government, not just deferral, but relief of taxes, thinking about direct grants to firms most affected, thinking about if you must use loans, don't have them be short-term loans, have them be long-term 25-year loans with an equity release at the end or something, if people want that. Anything that makes a balance sheet worse in this scenario, like more credit, risks making the mistake that we made 10 years ago, which was to mistake a solvency crisis for a liquidity crisis. And I'd really, really like us not to do that. Here's a table of the various interventions for businesses by different countries. So you can see in the UK there, they've got loan and credit schemes, social insurance payment delays, suspensions of utilities, tax reliefs or delays, grants and direct payments. Almost everyone's done a wage support scheme. Corporate bonds have been purchased in South Korea. There's been some temporary nationalizations of sectors in the UK. And you can see loan repayment holidays in countries like Germany, Italy, and sick pay costs, incentive schemes, and direct supports to apprenticeships in places like Australia. If you just think about this for a second, I hope that you're looking at the USA, right? You just see like the policy supports for a country like Germany have been extremely good, I would say. Very, very. No, I wouldn't call them comprehensive, but they have the three things that I think matter most in these scenarios, which is speed, scale, and scope. Right, essentially the public sector is washing the private sector with money for the moment. That's good, but we're not getting into the situation, I think, of understanding that the balance sheets of these firms are deeply impaired. Okay, so I would like to move from suspension, delay, deferral to outright relief. I think that's where we need to go. So if the firm owes rates to a local authority, quash the rates for the local authority, and have the authority take a credit from the central government. That kind of idea. This creates a situation where the COVID-related damage to the firm's balance sheet is wiped clean. That doesn't mean that the firm will recover. It doesn't mean the firm will automatically prosper, because of course its turnover is going to be lower next time when the economy switches back on. But it does mean that the liquidation computation is going to be much easier to make, to stay trading, and it therefore means that employment levels will stay as high as they need to be. So what kind of, I'll finish on this, what kind of policies to heal balance sheets? Grant aid to deal with utility and rent arrears of the most vulnerable sectors. I'm thinking particularly hospitality and tourism. These are very much SME type approaches. I wouldn't see these approaches working with large multinationals who can, in fairness, access the corporate debt markets. Removal of employer taxes and social insurance payments, and long duration debt, perhaps with an equity swap, who knows, or even just equity. The issue that's very different from the last time is across the world, we saw the taking onto the state's balance sheets of large property holdings, the bad bank approach. If we did that here, we wouldn't have property holdings. We'd have tiny bits of hundreds of thousands of companies. It's not clear that the state would be able to do that. I think this is probably the best way to move forward. So let me stop there, and thank you very much for your time.
Thank you very much, Stephen. And thanks for this Celtic Anglo-Saxon view. I'll hand over to Germany to Jens Südekum, who's been working also with the government in Germany to develop these solutions that have been in your table. So Jens, could you please come in?
Yes. Can you hear me? And see
yes.
Me? Yeah, great. So I don't have slides to share. So yeah, so thank you very much for the invitation. I'm very happy to be here. And I mean, many of the things that I was planning to say have already been said. So I tried to keep it short to have more time for the discussion. And so I want to divide my remarks into two parts. First, like how bad, how deep is the recession going to be? And I should say, I mean, I'm not a professional business cycle forecaster, so I don't have own numbers to share. So just some thoughts about the underlying to some of the forecasts we've already heard. And then the second part, a few remarks about government responses, and with a particular focus on Germany, because I've been most deeply involved in the design of the German package. So first, how deep, how bad is the situation going to be? And so I mean, pretty much from what Sebastian said, and also from what Stephen said, is probably, I mean, we all want to stay optimistic for sure, and we don't want to come up with horror scenarios. But my sense is that many of the existing scenarios that are quite prominently featured are probably too optimistic. And I would put some question marks to some of the forecasts we have. So if I look, for example, at the basic scenario of the forecast of the German Council of Economic Experts, the Sachverständigenrat, I mean, their basic scenario assumes a 5-week shutdown with a 3-week recovery period. So the shutdown, according to that scenario, should be coming pretty soon. So that should be, depending on where you put the starting point of the lockdown, but that would come in May 4, and then the recovery would be would end at May 25. And I'm really not sure about that scenario. And then if you look at the numbers, the yearly forecast for 2020 would be minus 2.8%. But then already by 2021, I mean, they would put a plus 3.7%. So if you take the average over those 2 years, we would be just doing fine. We would have 0.5% growth on average over 2 years. And I would put big question marks, you know, to these numbers. So Sebastian's numbers, and he called it optimistic scenario, were considerably worse. And I think, and I'm very grateful to Stephen's remarks, I think a big problem with all these forecasts is really that they are driven from an equilibrium model where you kind of assume a stability of certain parameters over time, especially when it comes to demand and when it comes to sort of the international dimension. So let me talk about international dimension first. I mean, the model that we've had for the Sachverständigenrat and many other models, I mean, they have to make assumptions, not only about the domestic economy, but how quickly other important countries in the world, from, I mean, where your sourcing destinations, and then also your trading partners for the export side, I mean, how quickly they recover. And I think these assumptions can turn out to be vastly too optimistic. I mean, we've seen, and we see that China seems to be bouncing back quite quickly, although it's not sure yet. But how quick will Italy and Spain bounce back? Because for German industry, these are very, very important sourcing countries where we get lots of intermediate inputs from. And I have big concerns when it comes to the United States. Obviously, Europe and Germany needs the United States, the market in the US, on the export side. And I'm very much concerned that basically the numbers in the US that you put into those models can be vastly too optimistic, because the approach that is taken there for ending the lockdown could turn out to be disastrous, right? Because if there's a country where you could run into a second wave because you have a premature end of the lockdown, I mean, the one country where I really fear that this could happen is the United States, which could then imply that, you know, down the road, maybe in summer or autumn, inevitably they could go back into another second shutdown, which would then have disastrous effects on the German export industry. So there are many question marks on the assumptions that you would have to put on the international dimension. But not only that, so I think structurally speaking, the models for business cycle forecast, of course, you need to have assumptions for essentially human consumption behavior. And it's not clear that many of those assumptions that were correct in the past are still going to be correct, you know, when you move forward. So we don't know yet, given this heart attack of the economy that Stephen has talked about. I mean, let's say if people really move back to their usual consumption behavior, when the lockdown has come to an end, so if people move back to traveling, to socializing, to clubbing and so on, all of this, or if people actually become much more risk averse and move to precautionary savings of some sort, right? Of course, this could imply that there's higher demand for certain products like home safety, home electronics, but less demand, you know, for tourism, gastronomy and all of that. And I think right now there's just no way how to forecast these behavioral changes. I think there's really simply no way because it's an unprecedented shock. So to just end on this first part, I really have big question marks when it comes to these quick V-shaped recoveries. So I'm more closely to Stephen's scenarios. I mean, not the ultimate disaster that he has put at the end, but I really believe, and we should be ready to accept that it will be a deeper U that we will see, so more pessimistic scenario moving around. And that brings me to the second part, so just a few remarks on government responses. And there I can also relate to things that have been said already. So if you look at the German package, which I want to talk about, I think in overall, I mean, for the time being, it's a good package, especially, let's say, when you compare it on an international scale to responses in other countries. First of all, it's huge. So the direct stimulus is only about 4.5% of GDP, which would be smaller than the US, smaller than in Japan. But if you include all those government guarantees and guaranteed loans, and if you add all of that together, it comes up to 33% of GDP. So this is really probably the most sizable package of any, rich country that we've seen. And it has been done extremely quickly. And both are really good news. So overall, I'm very satisfied with that. And the focus of this is really that the government is at the moment acting as a big insurance company. So it insures workers by short-term work. The scheme that avoids unemployment, avoids the loss of specific human capital, and then down the road can turn out to avoid very bad hysteresis effects. Because if you think of the US, where probably unemployment numbers will shoot up to something like 20% pretty soon, right? That would mean, when the US comes out of the crisis, whenever that will be, right? I mean, you have all sorts of job search going on, a reshuffling of labor relations. And we know from, that this can lead to very bad hysteresis effects that, people have been put out of work and it's not sure, let's say if they move back into the labor market, that the new job has even, remotely the same quality like the previous job. So, the short-term work scheme in Germany tries to avoid just that. And I think it's really a very good element. And you see it because many countries try to now to copy and to mimic this German short-term work scheme. The second focus is basically on liquidity loans, it's liquidity packages. So the largest share of the program comes through this public bank, the KfW. And I think it's the right approach. This insurance idea so basically to let firms survive through the crisis, also with the intention to avoid a big insolvency wave, bankruptcy wave, and then basically hysteresis effects on the firm side. So overall, I'm quite satisfied, but I see three big issues, unresolved issues, and three problems that I would like to put for the discussion. So first of all, is these balance sheet effects that Stephen talked about. So providing liquidity loans is fine as long as the shutdown period is a few weeks or maybe 1 month, and then recovery comes quickly. Then providing liquidity should be enough because many German firms in the past, especially like the medium-sized firms, they have been doing quite well over the last 10 years. Considerable earnings. We had this discussion about rising German profits, corporate savings, which were related to the German current account surplus. So all those corporate savings must be somewhere and must help you to kind of live through a certain lockdown period. So as long as the lockdown is not too long, and if the recovery comes quickly, then providing liquidity should be enough. But depending on lockdown length, and I said it, I'm really more pessimistic how quickly the recovery will actually be. At some point, we must realize that liquidity is just not enough, that it will at some point become a solvency issue. So that's why, we currently have this discussion, or let's see, the discussion is starting. For the very small firms, so for the ones with like 5 or 10 employees or less, they actually received a grant, right, from the government. That is not the case yet for firms with more than 10 employees. There's just loans. And I think at the moment we must consider the design of a package, how to hand out a grant program for bigger firms. But this program still needs to be targeted, right? So I think you should not provide solvency just by corporate tax cuts through the bench, because you don't want to benefit firms that effectively have not suffered from COVID, and there are some, right? You really want to target these grants to firms that really have suffered. And this is a kind of new task because these programs didn't exist yet, right? So one possibility is to turn these loans at some point into grants by elements of debt forgiveness, right? One idea would be basically to give these loans, but make the repayment conditional on future profits, right? So that you don't have like a fixed interest rate that you need to pay every month or every year, because this would essentially lead into these balance sheet problems that Stephen has talked about, right? All these medium-sized firms and large firms will run to debt overhang problems, and debt overhang is like the investment killer number one. So basically, as you come out of the lockdown and try to recovery, when you have this debt overhang problem, investment will be low, job creation will be low, and all of that will kind of slow down the recovery. So basically, that's problem number one that so far, even though the German program overall I'm quite happy with, we need to think about how to design specific grant programs that are basically targeted to firms that really need it. So the second problem that I see is, and relates to Sebastian's point, we will have the discussion very soon whether we need a big stimulus package, okay? When you look at these forecasts that imply a big, quick V recovery, so taking, for example, the German Council of Economic Experts, you can ask, for what do we need a stimulus package, right? So minus 3% this year, but plus 4% next year. So basically it looks like it has the underlying sound that basically nothing needs to be done, or the recovery will basically come automatically, so no stimulus is needed. With the more pessimistic scenarios, the stimulus package will be needed because there is this problem of aggregate demand in the longer term, and you need to think about it and plan for it now, right? So I think this is kind of a potential problem that you kind of start again too late with the planning of the recovery program, and you're not clear enough in your message, in your communication. But it's important because firms now kind of need to plan ahead for their business situation that they will have down the road next year or 2 years down the road, and they need basically the certainty that the stimulus package will come. And any uncertainty about this, any kind of talk about premature consolidation policies, which have already started in some spheres in Germany, right? Saying, well, next year we need to already start repaying debt and bringing public finances under control, right? I mean, this is kind of the message you don't want to send out at the moment for firms that ultimately have to decide whether they really restart business once the lockdown has stopped. So I think really we need to, we cannot start with a stimulus package right now, right? That would probably be too early, but we can start with a planning of a stimulus package and having a very clear communication and message that the stimulus package will come. And the last point is the international dimension, right? It's, you know, it's fine if Germany can, you know, put up a package worth 33% of GDP. That will help and that will do a lot. But other countries, especially in Europe, cannot do this. And this, of course, you know, will slow down the recovery for German industry. So Spain and Italy, if you add everything up, direct stimulus and the loan guarantees, that's more like 8% of GDP, right? So even the initiatives at the European level that were agreed upon last week, right? I mean, I think they go into the right direction. But overall, I mean, we're talking about 500 billion via the European Investment Bank, and then the SURE program of 200 billion. So if you add everything together, even the sum is much less, roughly less than half of what the German package is on its own, right? So I think basically we're on the European dimension, we just need more size for these programs. Otherwise, the European recovery will probably be too small, and there will be issues that basically Germany basically helped its firms, right, and prevented insolvencies. Other countries were not able to do that, so basically there will be a problematic scenario for the internal market that effectively some firms received support, other firms did not, depending on the country level. So I really think that my hope is basically when we discuss about the European Recovery Fund, which will basically, I think, starting today, this discussion, that we will put the right tools and also enough size behind those programs. Otherwise, it will backfire on the German economy. So let me leave it here, and I'm looking forward to the discussion.
Thanks, thanks to everybody. Very inspiring, very excellent discussion. I want to directly ask Stephen, if you look at your looking at your table and the different, very different kinds of policy measures that have been taken between the US and Germany, let's say, to put the two very different cases. May this decide on whether a country will have, you know, whatever scenario? So may the recovery then be very different depending on the kind of policies that have been decided now?
Yes, I think yeah, absolutely. That's going to be the case. If you imagine, you know, a country like Germany at the end of the crisis with a 10% unemployment rate, a country like the United States with a 20% unemployment rate. Obviously, the two economies are different sizes, but they're quite damaged as a result. The other kind of major point is we're often in economics, we're often used to talking about positive and negative spillovers in terms of, you know, pollution or you know, smoking, that kind of thing. We actually have the presence of a constant global negative externality, which is the relative levels of viral load in the population in a different country, right? So imagine that you are in country A and you have absolutely no instance of the virus. Actually, a very good example is Slovenia. Right now, I think they've had 45 deaths. And then take country B, like Ireland, there's, I think, 700 deaths, right? And then country C, the UK, the FT just came out, and apparently the UK government has understated the number of deaths by about 50%. At the moment, according to their estimates. Now, that could be wrong, of course, but there are different countries with different viral loads. Therefore, if they're exporting people, they're not just exporting the knowledge and services of those people. They're also exporting the exposure to the virus, right? So you can imagine a situation where global value chains start to fragment based on the degree of virality of the population, especially in the short term. So think about it in terms of packaging, right? So it turns out that the virus does not do very well on cardboard, okay, but it does very well on plastic, and it does terribly on copper. Right, so the virus can't survive on copper. This is my colleagues in materials science are working this out at the university now. So you can imagine a situation where stuff that's shipped in plastic from country A to country B, they simply stop. They said, we're not going to take plastic anymore. We're going to only take cardboard. Okay, that immediately disrupts massive supply chains. And then if you say, well, listen, we're not actually trading with, you know, the United States or the UK or Ireland or wherever, we're not actually trading with them anymore because we're worried about importing the virus through the airports. That is all you need to fragment global supply chains yet further, which, you know, in the most pessimistic scenario is what causes the disaster. So if we don't have a virus soon, number one, or if there is more than one curve to flatten, I think we need to examine our assumptions very carefully here. We are assuming that a vaccine will be available in 18 months. That's a huge assumption. Like we say 12 to 18 months. We've all picked this number, this framing out of the air. There may not be one there, so it's a big assumption there. The second assumption is that there is, you know, the curve. We're told to flatten the curve. What if we're flattening this curve and there's another curve to flatten later, right? So I would urge us to think along these lines. Coordinated multilateral policy responses that don't take into account those issues, the negative externality issue, the issue of, you know, relative virality around global supply chains, and then the final issue that I mentioned there, that we're just going to get ourselves into trouble. And it's something that I'm quite worried about, this differential, especially because I come from a small open economy.
Thank you. There's been one question by Sebastian back earlier on something that you discussed a little bit, this possible very big shock and disruption, and he's been talking about a forestral shock, which means that, I mean, like on the oil markets now, something very, very strange has happened. So maybe also to Sebastian and the others, is there any indication of something that may come up, such a very brutal shock? I mean, I just put the other side, daily life, I mean, it's astonishingly stable for us. I mean, everything's working. I mean, we're living, we're getting water and heat and anything. So is there a real danger, or what may be the indication for such a disruption, for a more brutal shock?
I mean, I'm not sure. Of course, we can always, there are always tail risks. Yeah, that something spirals completely out of control. At the moment, I don't really see that, at least not in a baseline scenario. And even, I mean, the oil market, well, what's happening there is that at a certain part of the world there's too much oil, and people don't know how to get rid of it, or how to store it for a moment, and the price has tanked. Of course, that will have repercussions on the US economy, because in the past years the investment in the oil industry has been very important for total aggregate demand in the US, and so this will amplify a shock, but still, I don't think it's a shock which completely unhinges the economy. I don't want to downplay that. I think that the scenario going forward is not optimistic, but this oil price shock is not something which will destroy the foundation of our economies.
Nicola, perhaps is this scenario discussed at the OECD?
Wider disruptions, you're saying, or
much more?
Well, I mean, yes, certainly it's something to think about, but I think we shouldn't create panic with our economic scenarios either. So what we're thinking about more is what we can do to work together to manage the crisis, to have a gradual return to economic activity that can work while keeping the virus under control, and what needs to be done to achieve that, rather than thinking about disaster scenarios. I think that's what we should concentrate on at the moment.
Any idea perhaps on the US? I mean, it seems quite brutal, as you mentioned, and you showed Stephen in your table. And when we look at the unemployment figures, which is a very different picture from Germany, I mean, the Kurzarbeit are still employed. Is there a specific danger for the US that the outcome will be much more difficult?
Sorry, this is a question for me.
Yeah, perhaps.
Oh, okay. So here, like I started my talk saying, we should really be careful about forecasts. So I'm being very careful about forecasts of the U.S. economy, except to make one point, which is that the U.S. It's probably a mistake to think about the U.S. economy as one thing. It's probably best to think about it on a state-by-state basis. So if you imagine the economy of New York is vastly affected by this, but other state-level economies are far less affected, as a matter of fact, which is generating some of the ill feeling towards the lockdown, because it's not as severe a health crisis there. So I think probably the best thing to think about is understanding it at the state level, where a state like New York will need enormous help, but again has the resources to deal with that. Precisely as Nicola said, these are highly resilient systems. But if you're in Washington State or something, it's quite a different experience. They're all ready for the crisis, and it's just crickets. it's not as severe there at all. So I think that's that level of heterogeneity is probably worth thinking carefully about.
Mm-hmm. Okay, thank you. There's one question by Andrew Watt from IMK. Would you intervene, Andrew? Are you still there?
Hello, can you hear me?
Yes.
Hi. Yes, no, it was more just I had a number of the panelists referring to the PMIs as an indicator of the situation we're in, and more importantly, the situation we're likely to face over the coming months. It just a question occurred to me, how reliable are they likely to be in the current situation? I mean, in normal times, these guys are looking down the pipeline, and it makes sense to rely on them to have a good feel for what's going to happen in the next 3 months, the next 6 months. But in a situation where everything's up in the air, is this really telling us anything more than what we know ourselves?
I mean, we put it in a larger context, even E4 or whatever indicator, short-term survey indicator, may be difficult to interpret because anyway, most firms now say that it's getting worse, but it doesn't tell us a lot about the quantitative part of it. Maybe Sebastian.
Okay, yeah, I mean, there are two dimensions in it. I mean, the first is, as Thomas rightly said, usually you ask, have your sales or are your sales expectations better or worse than last month? Or now, of course, there's a difference. You cannot just translate that into GDP figures, because of course there's a difference if 60% say, yeah, it's worse, but the drop is 5%, or if 60% say, yeah, it's worse, but the drop is 50%. And that is not really covered in the PMI. The second question is, which period they really refer to. I mean, if you, for example, ask them in the second half of March, do they really take the whole March as the reference scenario, or do they look at the last week where the business has been closed down? So I think we should monitor these indicators very closely, and I think they are probably the best we have, but we cannot just translate that linearly by linear transformation into changes in GDP. But they will tell us something about whether this is V-shaped or more U-shaped. For example, in China, we have seen that was Nicola's graph that the PMI has recovered much more quickly than during 2008, 2009. So this gives a little bit of hope. Nevertheless, of course, our economies are not the same as the Chinese economy, and maybe there you get the negative feedback loop from the drop in demand from Europe and the US and China. So the stabilization might not be sustainable.
Okay. Any further insight from the OECD on that? Do you follow indicators, or what is the general methodology to
yeah, I mean, yes, of course. I mean, I showed you this overview how unprecedented this crisis is. And then, so the concern that PMI might not tell us the same thing that they usually do, that we cannot plug them into our models and hope that we get the right answers, is quite valid. But still, we're trying to, to get our hands on what we can to understand the situation a little bit better in real time. That's why we're also looking at Google trackers and all of that. But certainly, so for the purchasing managers, there's a lot of uncertainty. So their answers might be different from what we usually see. And our models probably don't work in the same way. And everything depends a lot on, as Jens said, how long the lockdown will last. Can we, with our lifelines, Kurzarbeit and all of those things, if it was short, then perhaps we would return to something that is normal in some way, but the longer it lasts and the more countries are affected, the more we have to clearly think outside of the box here in terms of projections, but also even more so economic policies.
Thank you. Stephen, is there anything, I mean, indicators or how can we better anticipate. I mean, you said that we need to think in scenarios, and that's probably most wisest thing to do. And if it's difficult to take these short-term business cycle indicators, and they don't really tell us about the fundamental things like, like Jens said, the attitudes and the people's behavior is changing, right? And we don't see that in the numbers. Are there other indicators where we can track now to have early warning systems that tell us, well, there's really something very fundamental changing?
Yeah, so one of the things that this crisis has kind of taught me is the interaction of the if you like, the real and financial economies with the underlying health of the economy. We are, precisely as Nicola's presentation showed, we're going to move to an era of mass serological testing. So we're going to be doing blood tests on giant populations, and the idea of getting ready for the next pandemic, I don't believe this is the only pandemic we're going to see in our lifetimes. In fact, somebody rightly pointed out to me last night, this is actually the third pandemic of the millennium. So we're going to see more of these things, increasing the degree to which states across the world and multilateral institutions across the world have the ability to see, sense, and respond to pandemics is like, that's a very good thing. I think the indicator that I would look at is the prevalence of mass testing. Are large swathes of the population being tested for this or not? If they are, it's a very large degree of confidence, because these are biological tests, to the extent that the equipment is manufactured. In fact, I believe it's mostly manufactured in Germany, so that'll be a big boon to the German manufacturers of these medical devices. To the extent that mass serological testing is possible, then I think we're probably in a situation where we will have a as close to a real-time population level data set, and that should help us, if you like, see these things coming. Nobody saw this crisis coming, and I think the first case in Ireland was the 29th of February or something. So it's like, that feels like about 10,000 years ago, but it's true. So those are the data that I would be looking at much more carefully. We've seen that the ability even of national governments to count confirmed cases, deeply heterogeneous. If you just look at how the Germans versus the Norwegians versus the Irish versus the UK, just look at those are rich developed countries, and they count confirmed cases totally differently. So just being aware of those, and even deaths, those are really important sources of difference in measurement. Whereas the serological tests, if they're done in a consistent way and a very large scale, I think they could probably help us figure out on a very broad data-based way and analytics based way which parts of the economy to open where and when, and they'll also tell us which parts of the economy to shut off if there's a further outbreak. So this mass testing thing, exactly as Nicola said, is probably parts of phases 2 and 3 of a 4-phase response to the crisis.
Perhaps Jens, if you are very engaged in that, helping the government to find these answers, and the first run seems to have been quite good in referring to international comments on it. How aware is the government of these risks? I mean, that there may be something much more difficult ahead, and how to react to this potential situation where also attitudes change, like you said, in more profound ways.
Well, I think the awareness is there. I mean, if you look at the official approach, they really try to restrain all these calls for premature ending of the shutdown, because I think they're very aware of the second wave of the virus. So I think the awareness is there. And let me just comment on one thing that has been just said by Steve on the testing issue. I think this is really the most important thing we need to talk about right now, because basically, if you want to end the economic shutdown, if you want to reopen more and more sectors of the economy, you can more comfortably do that. The better is the infrastructure that you have put in place, so a protective infrastructure that kind of limits the risk of a second wave of the virus. And I think the most important elements are test capacities and these medical masks, right? So my view on this is basically 3-4 weeks ago, nobody was talking about these issues because the government was busy kind of orchestrating the lockdown and the rescue packages, and the building up of the infrastructure was really kind of a secondary priority, even though basically by now we're all aware of this so-called hammer and dance strategy to fight the virus, right? Where the hammer phase that we're currently living through kind of serves two purposes. One is to bring the number of new infections down, and that seems to work quite well, but also basically to invest in the infrastructure and bring it up. So intensive care capacities, testing, masks, and all of that. And I think the second purpose of the hammer phase, at least initially, was not really taken so serious, not even by the German government. But apparently this has changed now. I mean, there are many attempts kind of to get production, to increase the supply of masks and of medical equipment, partly done by trying to buy on the world market, but that's difficult because everybody wants to buy on the world market. So basically to increase supply by domestic firms, right? And so far there has been a focus on these masks, but by now, I mean, just yesterday, the government basically now put a focus on testing capacities, and the ministry, the Federal Ministry of Health, even put up a number which would be 4.5 million tests per week, which would be much, much higher than the capacities right now. So I think this is the right way to go. It's just a matter of speed, right? It's like how quickly you can ramp up the production and the capacities. I think this is basically the main lesson that I learned from the crisis, that basically now we're in an urgent need for certain products, right? And it's just very astonishing to see how long it takes to ramp up the production of these supply chains when you cannot rely basically on imports from China or from Asia in general, right? So I think the awareness is there, but I mean, we need it quickly, right? I mean, we don't want to have masks and test capacities up and running in August, right? We want to have it in May, right? And this is kind of the most important effort for the German government right now, in my view.
Mm-hmm. I would use the last couple of minutes for a short round on one topic which is raised by some participants, which is, let's say, the more social part. Usually crises end up in raising inequality, or very often inequality. And there has been an issue with inequality already before the crisis. So the big question is, will this crisis add up another dimension to inequalities? Will people that are already in lower paid jobs be the losers on certain jobs and so on? Maybe just a short take on that for Germany, and then maybe Stephen on especially Ireland, for certainly, but also the UK maybe. Sebastian.
Okay, can you hear me? Okay, yeah, we have, I mean, I think there are two dimensions. The first is the wealth inequality, and the second is the income inequality. And for wealth inequality, I think it's too early to see how this all falls out, because there will be some rich people who lose a lot, and there will be some not so rich people who lose a lot, and there will be some people who benefit from this crisis. So we have to wait a little bit how that comes up in the Gini coefficient. On the other, on income inequality, at least in the short run, I think it's very clear that this will increase income inequality. We just have, I talked about this survey we just have published yesterday, and we have asked the people whether they have already seen a drop in their income, or whether they feel that they will lose their job. And among those who have a net household income of less than 1,500 euros a month, 31% have said that they have already seen a drop in their income because of this crisis. If you go to the richer people, to those who have a net income of more than 3,200 euros, there's only 14%, so less than half, which have seen a drop there. And among the rich, 56% see that or say that they don't think that it will ever have an impact on their income. And among those poor, only a third believes that. And if you ask them about how they see their job opportunities, the poor, those with less than 1,500 income, 29% say they fear that they will lose their job. And among those who have a household net income of more than 3,200 euros, only 10% say so. So you see here that this impact of this crisis is very asymmetric. It hits the people, and at the moment, I think that's pretty clear. It hits the service sector, it hits the retail sector, and even if you go into manufacturing, there's the risk that the firms will use this crisis to get rid of the workers, which they seem, well, they don't necessarily need them in the future so much. So this really is a crisis which will make income inequality worse, at least in the short run.
Stephen?
I'd like to think about not wealth and income inequality, but inequality of access to the institutions of the state. So imagine a household where broadband is not prevalent, where the relationships in the household are not ideal, where perhaps there are caring duties for children who are who need more support than the average child. In this situation, the fact that there's no school to go to, the fact that there are no accesses to the supports that the household normally enjoys, limits the ability of the household to do many things. Okay, and so we see lots of ads and lots of op-eds and blog posts about how to work from home, and what's the best Zoom background and all this kind of stuff. And Thomas, yours is very nice, by the way. But what we're not seeing is how I'm coping with my two autistic children. Okay, how is my mental health being kept up during this crisis? There is a damage that is happening to households that is normally mediated by schools, by hospitals, by healthcare facilities, and that damage is silent. There's another kind of damage, which is people who have underlying medical conditions, let's say a deteriorating cataract, or maybe an underlying cancer, or maybe a heart issue, something like this, which is simply not being treated because the health systems of the world are basically focused on one particular ailment, which is obviously a very serious one. And again, you can see people who are having strokes and they're presenting at hospitals a day late, so that their symptoms are worse, right? So there's a household level damage that's being completely unmeasured at the moment, and we know it's there. Like, we're just talking to people who you all know, everybody who's listening to this, people who their mental health isn't ideal. They have care responsibilities, they have other things going on, and for them, they're accruing damage in this way. I would love to see a discussion about how we communicate with households as the lockdown ends. So at the moment, so these households are just basically suffering in silence, right? They're getting sicker, and they're having a much harder time of things than is generally being discussed. Okay, I would love to see a discussion of how the governments of the world communicate with all these households as lockdown restrictions ease. So it's very easy to turn around and say, "Stay in your house." Okay, it's actually very easy to say that. You just repeat that phrase, stay at home, wash your hands, you know, you've heard all the things, right? You've all heard those. If you turn on the radio now, you'll hear that. Turn on the television, you'll see that. When we started introducing if-then statements into the population, so if you're a waiter, don't go to work. If you're a professor, do go to work. If you have this issue, do this. If you have that issue, do that. How do you have that communication happen in a way that minimizes the extent of the virus spreading? That's a really serious problem. Like, it's not something that I have an answer to, and I would love, if anybody knows more about this, I'd love to learn more, because it's a pressing policy problem for lots of people. Yeah, so just to finish on that inequality issue, I'm very much worried about the inequality of damage at the household level, because again, like the PMI data and many other things, we're not measuring this at all. Like, we don't know anything about it, and you know, the precautionary principle should dominate here. You know, if you can spare someone some damage, should maybe think about doing that.
Many thanks, Stephen. Would you like to have a last word, Nicola, just briefly, because we're running out of time and would not.
Sure. No, just to echo what Stephen just said, I think it's extremely important, this crisis, and also the way to deal with the crisis, so containment or confinement at home, brings very multidimensional costs with it. So we're not only dealing with the virus infection, we're dealing with the psychological costs of isolation, also postponing other treatment at the moment. Regions also and countries will be very differently affected depending on whether or not the digital infrastructure is good or not. And we know there's a lot of inequality here in Germany. And then homeschooling, is really something, yeah, you need a computer and you need a parent who's able to school the children, and the impacts that we're going to see in the long run are going to be enormous. So we have to react on very many different dimensions, and also in a way contain the containment if we can, while controlling the disease as fast as we can with mass testing, because otherwise we're going to look at enormous inequalities once we get out of this, I think.
Many thanks, Nicola. Many thanks, Sebastian, Stephen, Jens, for this excellent contribution, excellent session. I would like to ask you, as you know, we're now having some participants asking questions in chats and Q&A. If you have some minutes and have a look, would be nice to maybe answer directly to one or the other question. While we are now having a coffee break, so unfortunately we can't offer the coffee directly, but we invite everyone to go out and have a breath and maybe 10-minute walk, or just a coffee. And then we will continue on the very next very exciting session on the prospects for financial markets, where we will present a study. A study will be presented on the scenarios for financial markets. So happy to see you back in, let's say 15 minutes, as we said, and then go back to work and listen to the next session. Thank you very much.